like since we started this trade room thing, I've been always saying that zero DT is the riskiest form of trading because what happens is firstly time is against you, like a big move, you are gone. Okay, and there's no way to manage like if the spike is come. So yesterday what happened on Friday, Thursday? So you see Nifty from 25. So entire day it was sideways consolidating. Okay, here it was consolidating. Here this entire period it was sideways. In fact, in this period options were spiking. Then suddenly some like 100-point candle, again 100-point candle, and it closed at the highest point of the day, right? Like no one expected that from 25 it will directly go to 25,400. Okay. But such moves, like though rare, can happen, right? And like, on this day, if you don't manage risk, you can lose a significant part of your portfolio. So today we'll discuss how to trade zero DT, what should be the way, and how to manage also zero DT. Okay. So the first way to do zero DT is to do only via spreads. Okay, we'll discuss everything ROI and like how much ROI can you make, what is the risk involved, and how do you manage also. Okay, so let us see. Okay, see. So okay, so if you see zero DT, what is the very big risk? Gamma risk. Okay, which means a big move. Okay, this is the biggest risk of zero DT. Okay, second risk is stop loss order jump. Okay. See, till now, y'all are lucky that y'all are not seen any big news during market hours, right? And all these moves, just imagine this move was without any news. Was there any news? Imagine if there was some good news along with this. This market Nifty would have gone to 25,700 also. Who knows? So, see, last few years, there have not been many jerks during market hours, right? No big bad news, no big good news during market hours. But whenever that happens, your orders will jump. Your stop loss orders will get jumped. Okay, has anyone seen a flash crash in Bank Nifty? It happened few years ago. Okay, so these two are the biggest risk if you are trading zero DT. Okay, and what will happen is like suppose because the risk to reward is so skewed. Suppose you're selling an option 20 rupees, that can go to 300, 400. So the risk to reward is so skewed that even if you lose big one day, you will need the entire year to just cover the losses. Okay, so we'll see how to trade. See Monday, what option do we have? Mid cap and bank X, right? Tuesday, Pin Nifty. Wednesday, Bank Nifty. Thursday, Nifty. And Friday, Sensex. Okay. So I'll show you a method on how you can trade zero DT. Okay. Yes, stop loss, even if placed in the system, will get skipped. It has happened multiple times. Anyone remembers this expiry? 18th April. See, as a trader, this should be by heart. If you're trading zero DT, see, if you do the same thing which everyone is doing, you cannot expect to make money. And I'll be honest, what option trading was 4 years ago, now it is not the same. 4 years ago, we were even making 10% a month. Now, even to make 2-3%, it's a task, right? There is zero room for error. Like you do one mistake, you are gone. Okay, so the game is very difficult, and the only way to stay in the game is to keep your losses small. Okay, so this expiry 14th, 18th April. Just see this in this move, many stop loss orders got jumped because the move was so sharp. Okay, I know many people lost a very big amount on this because Nifty apparently is assumed to be a safe index, and like this option was I think 1-2 rupees, went till 200 in one candle. Stop loss orders also did not get executed. Okay, clear, Gaurav? So let us see what should be the way to trade zero DT. Okay. See, 20 points is very low slippage. I know people who have faced even 200 point slippage. If you know the Sensex expiry, see this person, like, I'm not against anyone, but like I just noted for my learning that I should never do this. So this is a method, and since last 2-3 months I have been trading zero DTs. Okay. So out of the zero DT, I don't trade mid cap. Okay. So Tuesday, Wednesday, Thursday, Friday, and Monday I do bank X. But bank X, the risk to reward is not worth. The rest till it's fine. So I made money in all expiries, all zero DT. Okay. And in many expiries, my 10 rupees option went 300 also. Okay. Yet I was able to make money. So I'll show you what should be the process if you are trading zero DT. Till here, it's clear to everyone. Okay. Clear everyone. Yes. In this last 1 month. Okay. In live trading also, like if you remember in live trading also, I was trading and my Sensex option went from 15 to 300. Does anyone remember? I think it was the second live trading. From 15 to, I think 250 it went, right? And we ended the day. So I'll just show you the process and how you should trade. Okay. So see, what is the ROI expectation? See, my ROI expectation for the day is only 0.2% for the day. Okay. Anything above that is more, but I think 0.2% is a good expectation. Okay. For the day, even if you make 0.2%, that gives you around 4% for the month. And like I would say, like we lose certain months, still we are able to make 2 to 3%. Yes or no? So I am assuming, suppose if you have a 1 crore account. Okay. So on a 1 crore account, basically you are targeting around 20,000 daily. Okay. See. Okay. So now let us see how should we trade. Okay. So firstly, okay, so let us take some examples. So examples, because now it's not an expiry day, examples will be slightly like the premium will be slightly different, but I'll just give you an idea of how you can trade. Okay. Let us take Nifty example only. Okay. So see, my rule is, okay, for Nifty or for even Bank Nifty, okay, sell options around 20. Okay. When I say 20, not has to be exact 20, somewhere between 15 to 20. Okay. On certain days, it could be even as low as 10 also. So on Friday, there was very low premium, so I had to sell 12 rupees option. Okay. But I'm just explaining the logic. Okay. So if you're selling, okay, between letters around between 10 to 20. Okay. Ideally, like should be greater than 10, but okay, so this is for Nifty. Nifty, you will get low premiums. Bank Nifty, you'll easily get. So Bank Nifty and Sensex, you'll easily get 25 to 30. Okay. So Nifty and Fin Nifty, the way is same to trade. Okay. So let us discuss first Nifty. Okay. So the premiums will be slightly different because now it's not an expiry date. But if we suppose sell similar premium, So I ideally sell 25,700 call. See, on expiry date, like whatever, wherever you're getting 15 rupees premium, that you are selling 10 to 15. Okay. So ideally, on an expiry day, I'll sell such premiums. Okay. So I am selling 1770. But see, what is happening in zero DT is the spikes are so brutal that earlier what used to happen is we used to sell these premiums, we used to manage. At 17 rupees going to 30, we used to shift the puts and manage. Right? You remember that, right? How we used to trade earlier on expiry day. Everyone knows that, right? Okay, but now what has happened is now the moves are so brutal that you don't have any room for adjustment. So now what you will do is whatever credit you are getting, suppose if it's less than 50 now, you buy 50 points away only. So which means if I have sold 25,700, which call will I buy for hedge? 25,750. This I'm immediately buying. Okay. And on the put side, I'm buying 24,750. Okay. Okay. On expiry day, the payoff will be slightly better because these premium which you are buying will be slightly lesser compared to this. Is it clear, everyone? So generally on expiry day, what happens is you're selling at 12, you get to buy at around 7, 8. Okay, clear? Okay. So see now the key comes in, whatever this max loss is, whatever this max loss, okay, this max loss will come on your screen when you don't do anything. Okay. So this max loss will ideally happen if suppose you have sold 700 call, right? So ideally this loss will come that suppose market closes at 750, which means your buy also is expiring zero and in sell you are losing full. Is this clear to everyone when this max loss will come? Okay. So whenever it intraday market spikes, your max loss will be like suppose if this is 1,000, your max loss won't cross more than 500, 600. Is this clear to everyone? Is it clear? Okay. So suppose, so now the key comes in, whatever your max loss is, should be less than 1 to 2% depending on your risk appetite of your trading capital. Okay. So if we talk about the 1 crore account, right? This 1 crore thing. Okay. Or for simplicity, we can like even reduce the numbers, but okay, let us do 20 lakhs. So it's easier for every. Okay. So on 20 lakhs, you want to make 4,000. Okay. So this is the return you want to make. Okay. Max risk you want to take is, suppose we are assuming your max loss should not cross 1%, which means 20,000 is the max loss. Okay. And 4,000 you are this credit. Do you want me to keep on 1 crore or 20 lakhs? You tell me. So accordingly, I'll change the number. 1 CR. Okay. Then let me do it all at once. Okay. So which means you are ready to lose 1 lakh. Okay. And this is the max loss. This loss will come if you don't do anything. Ideally, your loss will be less than this. Okay. Because you will do some adjustments also, right? Okay. So here I am assuming 1%. Generally, I keep it 2% because if it's 2%, I will lose 1%, right? Okay. So now what you will do is on this. So people, what they do is they use the entire margin, right? You have 1 crore, you use a full margin. So now I'll create the trades in such a manner that my max loss is 1 lakh. Okay. Which means I can do up to 100 lots. So if you remember, I shared my position on Friday on the group. I was trading Nifty. I had shared my entire Nifty positions on the group. Okay. Okay. So this is what we exactly want. We want to make 18,000 and the max loss is 1 lakh. Okay. Is this clear? But how much margin have you used on a 1 crore account? Only 26 lakhs. Okay. So the first mistake people do is they'll do 5x of this quantity, right? They'll use the entire margin. So you have to keep your margin in check that your max loss should not cross more than 1 to 2%. See, if you're starting, I would say max 1%. Okay. So now, is it easy to create something like this? Okay. And you start creating by 9:30 and you start creating in tranches. So generally what happens, there's small spikes which are happening. Okay. So if I want to punch 100 lot, 30%, 920 and slowly add if any spike. Okay. See, if you are confident, you can add 100 lots at start only. But I generally, because see, I ideally punch in Nifty up to 30,000 quantity. So I start with 10,000. If there's a spike, I'll add 15, 20, 30. Because see, you have to remember this 20K, you'll require the entire day, then you will get, right? So it's not that you create the position, instantly you will get money. So you can patiently add to the positions. Clear? So see, this is something you create on every day. On Nifty, the hedges are 50 points. Okay. So see, now what happens is Nifty is at, suppose in this case 343. On expiry day, like these premiums will be slightly lesser. Okay. Suppose Nifty, there's a spike and Nifty goes, suppose from 3,450, it goes to 450. Okay. What will happen to the call? Assume the call from 19 goes to 30. Okay. So what I do in the entire day is, if suppose this 20 rupees, if it goes to 30, okay, then what I'll do is I'll slowly roll up my entire spread. So this 800, 750, I'll come to 850, 800. Okay. As the market is moving the entire day, but I always make sure that I am in, like I'm at least, I try to be at least, so now the premiums are low, but at least 150 to 200 points away in Nifty. So ideally around, you can say, see, now the premiums are low, so ideally at least 0.6 to 1.51% away from the spot. Okay. Okay. So see, basically, how do you manage this? Is because see, you already know that your max loss is 1% of your capital. Okay. So there are no stop loss on any sold legs. Okay, Sachin, there are no stop losses. Now you know that your max loss is 1 lakh, but if you do any adjustment, so for example, if the market is going up, okay, assume the market is going up, and I just add some more puts with proper hedge. You'll see that loss on the upside has reduced. Okay. So you know that via adjusting the loss which you see on this, like the max loss, it will always be less than that. Okay. Okay. So yes. So now how do you do this? Till here it is clear. So basically the goal is to buy. So if you see on this, like on your deployed margin, you are making 0.6%. Okay. So rest margin anyways you can use for different strategies like stocks or something. Okay. So for expiry, whatever margin you are deploying, you're still making decent. So basically what you do is on the expiry day, okay, for suppose the Nifty expiry, ideally the premium you should sell is between 10 to 20 on, like depending on the premium, because now the premiums are low. You'll have to sell slightly around 10, 12. When the premiums are high, you'll get to sell also around 20. So basically, ideally the credit you are getting is somewhere between 20 to 40. So you buy only 50 points away. Okay. See, same thing if you buy 100 points away. Okay. I'll just show this. What will happen is, just a second. This is very important because see, I have traded BankX last week. I have traded Nifty expiry. I have traded Sensex. I have like I don't trade Nifty much, but I have traded most expiries. Okay, and even they were very brutal spikes. Still, I was able to end up in the green. Okay, so what we had created is 700 and 800. So I'm just creating one more in which we are suppose buying 24,800. 25. Okay. You're buying suppose 100 points, 25,800. And on the put side, you're buying 700. See, so in this case, what happened is your risk increased by additional 1%. Can you see? Same quantity, but if you're buying hedges 100 points up. Okay. So your risk increased by almost additional 1%, but the profit you are getting max like only 10K, which is 0.1%. Okay. So rather than doing this, I prefer if you want to take the same risk, right? You can do double the quantity. Still, you'll make 36,000 here and you lose 2 lakh 10,000. Is it clear, everyone? Is it clear? But in this, still you'll make 36,000 and lose the same amount. In this, you'll make 31,000 and lose, like in this, you lose even lesser. You lose 2 lakh 10,000 only, 12,000. Here you're using 2 lakh 20,000. Okay. And what happens is, see, sometimes this big moves, right? Like for example, Nifty, mostly out of 50, like suppose we have around 252 expiries in the year. Okay. Out of 252 expiries, okay, only 20 will be extremely trending. Okay, in which you will see the actual max loss by EOD. Okay, is it clear? Okay, so now till here it is clear, then I'll move ahead. Everyone, I already explained, right, Harshit? In this, I'm buying 50 strikes away hedge. In this, I'm buying 100 points away hedge. Okay. So Nifty try to buy 50 points away hedge. Okay. Now, so here what will happen is, okay. So this is your trade. Okay, so now what the plan is, we manage, how do we manage triangles? Same manner we manage the spreads. Okay, so suppose if there's a spike and this 19 rupees call option goes to 40. Okay, what you will do is you will exit the entire spread. Okay, suppose this entire spread you will exit, which is 870, and you will come to a put. Basically, you are matching the puts, like basically matching the premiums. Suppose if it goes to From 19 it goes to 35. So what will happen is you will book profit in this 800, 750. Okay, some profit you will get. And so now, see, now it's not an expiry. That's why you're seeing 17 and 15. On ideal expiry day, you will get at least 5 point credits on each side. Okay, so you'll get the risk to reward will be better on the expiry day. Like you will get more credit. Okay. Okay, so basically what happens is, so the way to manage this is, firstly you are prepared to take the max loss, and your goal is to defend this max loss if there is a move happening. Okay, so suppose market is spiking on the upside. So what I do is so this spread will give me some money. I'll exit and I'll come to a spread and I'll match the premium. So suppose this call goes to 40, assume. So what I'll do is I'll exit this spread and sell a 40 rupees put and buy like 50 points away. So suppose that will be at 25. So I'm getting 15 points additional, and I'll keep doing this the entire day, but always I'll be far from the spot. I'll never come very close to the spot. Is it clear? Okay. So basically the goal is you create spreads. Okay. You cap your max loss. See, it's not an expiry. That's why a year, like if I do any adjustment, it won't be possible. Like it won't be shown properly, but I'll just show you. Okay. Suppose, so basically, ideally what we do is, suppose there's a spike on the calls. Okay. The call has gone to 40, assume. So what you do is, suppose it has gone to 40, let us assume. Okay. Okay. So you do this till the time your call becomes 18. Okay. So till your strike is 80 and you manage this, and see, this year, like all this will has to happen before 2, because after 2, what will happen is there is no premium on the other side to do any adjustments. Okay. So that's why you start early, you adjust properly. So did you see my post on Friday? Okay. So I'll just show you again. I'll just show you just a second. So I was trading Nifty. Nifty spikes were coming. Okay. My profit was like reducing. No, simulator also won't work because it's not an expiry date. The premiums are completely different. Okay. But ideally, what generally happens is on the expiry day of Nifty, if you are selling, suppose 13 rupees option, 50 points away will be 7, 8. So ideally, you will get 6, 7 points credit on the Nifty expiry, and Bank Nifty, ideally, you will get around 10 points credit. Okay. But in the hedge, after like hedge, like in the spreads. So basically, the goal is if there's a spike on any side, okay, you exit the other side and you roll up the puts with proper hedge 50 points away only. What many people do is they roll up the hedge, like they roll up the strike, but they don't roll up the hedge. So if market reverses, they again face a loss on the downside. Okay. And if you keep doing this the entire day, okay, by 12:30 to 1 legs, okay, you will see decent profit on your screen. Okay. And whatever credit you have started, your credit will also start increasing. Okay. Suppose you started with suppose 18,000 credit. You do one shifting, yet the credit will increase. Yes or no? You do one shifting, your credit will increase. So ideally, whatever amount you have started, if there is market is moving, you will end up making more. Okay. But you are prepared to take the max loss. Okay. So if market so basically the plan is you adjust till the time your call becomes ATM. Okay. Once the call is becoming ATM, okay, you exit everything and you start the process again. But what will happen is even if your call becomes ATM, like your loss won't be much, because this max loss you see on this, like this max loss will come if your buy strike also expires worthless, right? But in the spike, what will happen is suppose this 20 is going to suppose 40. Even this 14 will go to 30, 35. Yes or no? So ideally you are losing less win the spread, and put side also you're getting. So your loss won't be much, and you again start the process. Is this clear? See, if possible, I'll do on one day live on the expiry day also. Sensex, I'll trade live with you all, and I have done one also once, but again I'll do so that things become more clear. But this is the basic plan. But the key is the max lot should be defined. Okay, so I'll just show you the Nifty thing that is low. Okay. So see, if you do this every day, so for Nifty, the hedges are 50 points away. For Bank Nifty, it will be 100 points away. Okay, because you don't have 50 strikes in Bank Nifty. Okay, and if you do this, okay, every day, see if your max loss is 1%, ideally you shouldn't lose more than 0.5% for that day if you manage well. Okay, and if you're right, you're making 0.2%. Okay, and if you do this well, out of 252 expiries, at least more than 200 you will make money, and 20-30 expiries, suppose you lose. So you lose only when there's a very sharp move in no time. Like suppose you don't get time to adjust, that is the day when you lose. Okay. See, you will do adjustment only if the spot moves. If the spot is not moving and the premium is spiking, you don't have to do any adjustment. Because eventually the strikes will expire worthless. But you will do adjustment if the premiums are like suppose a 20 rupees option is going above 30, then only you will do some adjustment. Okay, because if you do random adjustment, what will happen is you like market reverses, your stop loss will get it. Okay. So let there be a very big spike, then only you should adjust. Like so, suppose I generally adjust if I am selling, suppose around 20, till the time it is not going above 30, I'm not doing any adjustment. Okay. And see, you are margin free. Like suppose a 1 crore account, you have 75,000 lakhs free to do any adjustment. Okay. Oh, just a second. So if you trade by this logic, I think this Friday, we'll trade live also. So things will become more clear. But this method I've been experimenting since quite some time, and I found it very good. Like in fact, even those expiries in which there was spike, I was able to end up in the green. Okay. See, same thing. See, now the premiums like won't be like you won't get the right idea because premiums are like the OTMs are also expensive, right? Suppose I'm selling 5600 and if I'm buying suppose 5700, what will happen is I like both are having almost similar premium, right? So you're getting only 3 points. But on the expiry, that is not the case. On expiry day, you get like the OTMs are not as rich as this. Okay. So, so basically, this is the rule which you follow. Okay, I'll just show you. Okay, someone asking if so the momentum was high, prices of PDH, how much risk should we take as there is won't be much scope for it. Okay, so see what happened on this Nifty days. These moves were very sharp, right? Like by the time you could like this move happened, this move happened. So it was very fast, right? So your strike became ATM very fast. So on this day, only thing you can do is you can get more credit on the put side because in this move, the puts did not decay. So you can more credits on the put side, but ideally on such day, you'll face a loss because the move is so sharp. Okay. On this day, I was lucky to end up in the green because in this move, okay, because I was positionally long on the market, I'll show you. So in this move, even though like bank Nifty did not give me money, but all my stocks went up. Okay. So, so see, this is the rule you have to follow. Okay. Your loss is capped, so you don't panic whether the option is going to 500,000. You don't have to panic. Okay. But the rule is if the strike is becoming ATM, ideally you should exit. See why you should exit if the strike is becoming ATM. Okay. No, inverted triangle won't make sense at all. Okay. Okay. So, okay. Inverted triangle won't make sense. Rather than doing inverted triangle, exit and again start fresh. Because what will happen is in inverted triangle, you will make. So basically, ideally, you are betting that your leg should give you money, right? If that is bleeding, that is at max loss, and if market reverses, the other leg which you have added, that will also start giving you a loss. So the key is still the strike is ATM you manage, okay? And it also depends when your strike is becoming ATM, okay? So till that strike is becoming ATM, you manage. If it's ATM, you exit. See, why do you exit? Can anyone answer why you exit if the strike is becoming ATM? See, what happens is if the strike is becoming ATM, right? Suppose Nifty is approaching 700, right? Now, what will happen is as it crosses 700, okay, what will happen is suppose and after closing like suppose crossing 700, it stays there only. What will happen is this 750 will decay, right? This hedge, like you have bought, that will decay, but the sell leg won't decay. If the strike is becoming slightly ITM, this won't decay. So rather than doing this, exit everything and again start fresh. Okay. And it all depends when your strike is becoming ATM. So the later it becomes ATM, the more difficult it will get. Okay. So my rule is whatever credit I'm getting in the morning, if I'm making 60 to 70% of that, okay, I exit everything. Okay. Or around 130. So now you will ask, why should I exit? If I can get the full premium, why should I exit? And why around 130 should I? See, so what happens is these ICs, if you okay, so you have to understand that this buy leg which you are buying, okay, this will protect you, okay. But what happens is if the move happens very late, suppose after 130 the move comes, what happens is because the theta decay is also there, okay. Suppose market comes at 750. So ideally what will happen is the 700 call will be at 50, but the 750 will start decaying. So this won't save you much, okay. And all adjustments you can do is before two, because after two, what happens is it's very difficult to do adjustment because there's no premium on the other side. So to get premium, you need to come very close to the spot, which is again risky. Okay, so try to basically whatever credit you're getting, if you're getting 60 to 70%, try to exit. Okay. So like this is not syncing here. Else I would have shown you what like I pushed on the group. I'll just share again. Till here, is it clear first? Then I'll move ahead. Completely clear. Now the biggest risk we were facing is on certain expiry days, like an expiry like this, in 1 rupee option is going to 7. You know your max loss is capped under 1%. Yes, you know this, right? Okay. So you know your loss is capped. Okay, so see, this was the move. From 1 rupee went to 50, it did not stop, went till 220, 230. Okay. But on such day also, if you know that your loss is under 1%, you don't have to worry. Because on good days, anyways, you will make money. And certain days, like no matter what you do, you are bound to lose. So when the market is extremely tending in one direction, you will lose. Okay. But you will survive on days when there are spikes on both sides and the spikes are cooling off. And most of the time, that will only happen. Okay. There will be spikes and it will again cool off. So something like this. This spike in one candle, So this 10 rupees option went to 140, but your stop loss did not get triggered. And see, immediately closed at zero. Okay. So most of the time, you see this spikes, people call it hunter algos or whatever. But you are able to sustain the spikes because your position is hedged. Okay. So I'll tell you, I was trading around 30,000 quantity on Friday. Okay. The max loss I saw on my screen was 12 points. Okay. And that too when my 10 rupees option went till 70. Oh, sorry, Thursday. So Thursday, max loss I saw when the market went down was 70. Like basically put went till 70. So like because the position was hedged, the max loss was 12 points. Okay. But if I was like suppose trading naked, a 10 rupee option would have like stop loss would have got hit at 40, 30, whatever, right? And see a 10 rupee option, if it gets stop loss, if you get stopped at 30, and if you're again selling 10, 10, there's no way you'll make money on that day, right? Suppose your 10 stop loss is got hit at 40, you lose 40 points. Again, you start with 10, 10, you'll make max 20 points. Okay. So rather than doing this, try this spreads because what will happen is on the days you are losing, your loss is capped. The days you are winning, you are able to basically navigate that day very smartly. Like say for the spikes are also happening, what will happen is you get to add in the spikes. Okay. Suppose, for example, this call goes to 50. Okay. Now suppose something like this happens. See, something like this will also happen as you keep adjusting that your premiums are becoming expensive. So this is not giving a true representation because the premiums on expiry day will be different. But your credit will start increasing as the premiums are increasing. So at 20 rupees going to 35, you will come to 35, 35. So basically, ideally, you are getting more credit than you actually intended. Yes or no? Is this clear, everyone? So ideally, something like this will happen on the expiry date if the market is moving. But still, your loss is always capped. Okay. So just focus on this on expiry day. Okay. And this will all will come with practice. The more you practice, the more confident you get. But confidence will only come if you have managed to note all the difficult expiry. See, I am confident of trading no matter how big the move is because I have literally, there's not a single day since the weeklies have started that I have not traded any expiry day. Okay. So I've seen each move so closely. Okay. And on that day also, I managed using like, it's not that I'm not lost, but still that adjustment, that management gave me certain learning. And I always make sure. So earlier I was not doing spreads. Earlier I was doing naked. I was managing. But now, like since this in this volatility, it's impossible to manage because like one option 10 will go to 100 in no time, and again it will come to 10. Okay. So I think this sheet is always already shared with you. If you want to again share, study each and every expiry of this. Okay. On this expiry, go backdated and see what how you could have managed. Okay. So my confidence comes in on these expiry days I've tested, like how I could have managed. Okay. And doing that, I understood that, okay, how I can trade. Okay. See, most of the time, what happens is 80% of the time, the spikes will cool off. Okay. Only 20% of the time, the spike will sustain till EOD. So, see, most of the time, this zoop and zoop, right? In spread, you won't even realize what happened. Okay. But if you are trading naked, what will happen is, अरे 60 पे कट गया, let me sell पीछे का भेजा वो भी कट गया. Okay. Credit like I see we are doing only credit spread, then how should we manage? See, if you're doing only, like basically you're doing a, suppose your views on the upside and you're only selling put credit spread. So you have to decide a level that below this level I'll exit my trade. Because in the credit spread on expiry day, even if your view does not go right, but the market does not fall much, still you will make money. But you will lose money when below a level market, like your view is negative. So you have to decide a level, okay, or you decide the max loss. Okay, I'm ready to take the max loss. Clear, Sachin? So in these ICs, we are not keeping any stops on the individual legs because see now, like we talk about Jane Street and all, but people are become more smart. These algos and all, they are designed to hunt your stop losses. Okay, so if you do this, you don't have to panic on any given day. Your loss is capped. Okay, you just have to focus on your adjustment. And most of the time, the spikes will come for a few minutes and it will cool off. So this will allow you to stay in the trade and like, not panic. Okay, is it clear? Okay, so on this Friday, we'll do this again on Sensex. But this is the method you need to follow. Okay, is it clear completely? I'll just revise it again. Okay, so see, firstly, zero DT. Okay, earlier what used to happen is you used to sell naked, we used to manage, right? But now what is happening is there's no scope for management because one side the spike is so brutal that like a 10 rupee option will immediately become 100. Okay, so your max loss for the day is it. Okay, and the two biggest risk on the expiry day is gamma risk and stop loss order. So take care of that. What you can do is you can create spreads. Okay, okay, these are the expiries. So Nifty and Bank Nifty, especially Bank Nifty and Sensex, you can buy 50, 100 points away. Nifty and basically the smaller indices, you can buy 50 points away. Okay, ideally, I sell between 10 to 20 for Nifty, Fin Nifty and 20, 30. See, why I'm selling so low premiums in the start is because if there's a movement, I should get time to adjust, right? If morning only, if I'm selling, suppose ATM straddle, there's a move, I don't have much scope for adjustment. Okay. So whatever your capital is in the spread, the max loss should not cross more than 1%, or you can do 2% also on the, and like idea, like accordingly, your sizing will change. Okay. So your return will also change. Okay. So this is one thing that max loss should not be more than 1-2% of the capital. Okay. Now, how do you execute? See, ideally, like if you want to do 100 lots, you can start 30 to 50% in the morning and keep some buffer for adjustments. Okay. Suppose there's no spike, you can do the day with 50% only. Okay. Or you can add slowly also later when the market range is established. Okay. Because anyways, in the spread, like even if you lose max 2-3 points. Okay. Always try to stay 0.6 to 1% away from the spot. Okay, till the strike is 18, you manage. Okay, once it is becoming ATM, even if it becomes ATM, your loss won't be much. You can exit and start again fresh. Okay, if you are getting 60 to 70% of your credit, you can suppose your credit is suppose 20,000, and if you are getting already 13-14,000 on the screen, exit everything. Okay, or by 132, try to exit everything because in the second half, gamma move will kill you, and you don't have any chance to do any adjustment. Is it clear, everyone? Till now? Clear, everyone? Like, how are we taking the trade? How are we adjusting when to enter, when to exit? See, the more you practice this in real time markets, then only your confidence will increase. But this is something you need to do. Many people will think, why should I buy hedges? Why should I give money in hedge? Okay. See, but the benefit of the hedge is your loss is capped. And see, out even one expiry you survive. Like suppose Nifty expiry you would have survived, right? That only will take the money you lose in hedge every day will take care of all the expense. And even if like the hedges like are losing, still your margin also get reduced, right? If I do this naked, if I'm doing this quantity naked, See, with the hedge, the margin is 26 lakhs. Without the hedge, see, without the hedge, one similar quantity, you require 75. So you're ideally requiring only one third of the margin, but your loss is always capped. Okay. 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 So just a second. Yes, yes, I will share the Excel. Okay. Okay. Already there on the portal, but I again share. So try to follow this rule this Friday again. Like anyways, I'm planning to keep two live trading. So Thursday, Friday, Akash should mostly be fine by then. So you'll understand how like we can trade both the expiries. Okay. So, but make sure that you don't get too greedy and increase your credit. Okay. Your max loss should be 1 to 2% of the capital. And if you follow this method, if you trade all expiries properly, you will make decent return in the year because you are not worried about the spikes. No matter how big the spike is, you are able to stay in the trade. Okay. Okay. So this Thursday, Friday, we'll try to follow this method and I'll explain how I'm trading live. Okay. I'll share this Excel in which all the difficult expiries I'm mentioned. Okay. And I written a Twitter post also, which got very good response. Okay. So this got almost 240K views. Okay. I explained like, so you'll understand like, see this on this day, 2nd of 2024, right? See, so these 100 rupees going to 600 on the call side. And on the put side, you see from 10-20 rupees going to 12.50. Imagine even one day you are stuck in such spikes. And these spike stop loss are not triggered. Okay. So if you do zero DT, you are able to manage. So like the last Friday Sensex expiry, my 12 rupees option went till 450. And I ended the expiry at 0.3% gain. Okay. So if you remember, market suddenly cracked. So you study this post also. Okay. So see, in trading, it's simple. Focus on one thing, try to master it, try to know all the nuances, what are the risks involved, what can go wrong, okay, how you should manage. And then only you will be able to manage such moves in real time market. Okay. So try to maintain your own journal also, like all the difficult days you think, and try to think how you can trade these days better next time. Okay. So these spreads and all, I've started to use once I realized that, okay, like what went wrong. Okay. Yeah. On Nifty, I'm trying to show this is not open just a second. I will just a second. Just a minute. Okay, so I'll show. Can you see this? So can you see? Can everyone see the screen? Okay, so I had 24, okay, 900 put short, 24 850 buy. Yes or no? This is very important. Can you see? So it was at 28, buy was at 60. And on the call side, I was on 150 call and 200 call, and hedge was 2. So did not roll down because the market was going down slightly, only few quantity I rolled down to 1 because the put spiked from 17 to 28. So I rolled down the call from this 10 rupees call from 8 to 15. Is this clear? Everyone, you will get an idea also how to do adjustment with like these are exams. So you can see that you're getting 8 points credit. So like on the put side, you can see there's almost a 12-point credit. Can you see? And the call side also, it's like 6 7 points credit. Okay, so then what happened is you can see the M2M is 2.6 lakhs. Okay, now you see this put went till 32. Can you see yes or no? 24,900. I have highlighted in blue. 24,900 put went till 32. Okay, what I did is I rolled down the entire spread to 150 to 100. Can you see? So 11 I sold and 5 I bought. So 6 point I'm getting here and 12, 13 point is here. So you can see how there's credit. Like even 5 points are here, 6 points on the call side and put because put is expensive, it is around 14 points on the put side. Okay. M2M is reduced because puts have spiked. Clear everyone? This will give you a real idea what is happening. So please respond. Okay, so I understand that like if you're able to understand or not. So you see, I started with 18,000 quantity only. Okay. And this 18 also I added slowly. I started with 10, 15 and I slowly added. Okay, put spike. So I rolled down the calls. Okay, I rolled down the entire spread. Then you see I increased my quantity to 29,100. Okay, put 26, call 16 and hedges 50 points. Okay, so I've written everything. Don't come too close and create in such a manner max loss is capped. In spike, even 50% loss won't be screened. Okay, at 12:16 there was spike. M2M from +4 went to 0. Okay, then I said I have IC which is open. See, now profit is 5 lakhs. How? Why? Put came to 25, call is 14. Premiums are started to decay. Yes or no? Can you see? But I'm in the same strike. I did not do anything. Same strikes, did not do anything. M2M 7 lakhs. Can you see? Why? Because the put came to 20, call came to 12. Because I was in spread, I was able to like, stay in the trade. And you can see the credit. 12 you are selling, 6 you are getting. 6 side points on the call side, put side has 10 points. See, now can you see I reduced the quantity 14,200. Can you see or no? Why? Because the puts decayed, calls decayed. Right? And now what will happen is it was very like it was coming closer also to 130. Let me see, I've written also. Yeah. Okay. So this was 14,200 quantity. Okay. Can you see? So then what I did is, if you see, I exited this everything and I started with far strikes. You see, 200, 250. So I went far and put also I went far. Okay. losses were like capped, and you see the quantity is low. Put is more. Why put is more? Because the call that spike, right? And on this day, what I kept is I kept adding more on the put side. Okay, but my quantity was very low. So eventually, like because earlier I had made a decent profit at EOD, like I did not lose much. Okay, is this clear? So you can see 9.36 just by adjusting the trades. Okay, and but the key is closer to market time around 1:30 to exit everything. So if you see here how I went from 100% to 50% quantity immediately, and slowly I started to exit everything. Because the now to get this additional 4 points, okay, it will take time. Clear? I already explained why the put quantity is higher, because the calls were spiking, right? Here the calls were spiking and the put did not decay at all. Only the call spike. The put was there only. You can see the put is also in loss. So I like the put is in the up move only, both spikes. So I like, let me, instead of rolling up, let me add more on this put only. Okay. So why do I exit this put in loss and roll up? Rather add, let me add here only. Clear, everyone? So try to follow this every day. See, I can guarantee you. So I am confident trading any expiry, no matter how brutal the spikes are. Okay, because see the confidence comes in because I have traded like since May 2016 was the first time when weekly option started. Since May 2016 to September 2024, there's not even a single expiry which I have missed. Okay, so I've live seen the moves. I know how brutal the spikes can be. I have noted like all the difficult days, and I managed also on those days. Though on some days I ended up in the loss also. But if you trade live enough, then only you'll get the confidence to trade. Like even if you attend the class and you like in the real time markets, if you see those moves happening, you'll understand what is the risk involved in zero DT. And that's why every class you see me talking about zero DT since last 3 4 months, that the risk is too high. Okay, and the risk is I feel still about to get realized. These are still smaller moves. I am sure in next 1 2 years there will be a very brutal move which will kill almost all zero DT players. Okay, so like those who are like completely naked, because see now these moves are without any news, right? You just need a very big trigger, and in that can easily take Nifty 3 4% higher intraday. I have seen index falling like flash crash. I've seen Nifty falling 500 points in just 1 second. Like one tick was 500 600 points, right? Bank Nifty. So, so the goal is to create spreads and manage. See, on this 30,000 quantity, my max loss was 7.5 lakhs, which is very good, right? And the max I had seen was -4. But still, I could stay in the trade because if you see, when this profit was at 2 lakhs, so this was 32, this put had gone to 72 also. Suppose I had lost around 12, 13 points, was quantity was 27. But you see how I was slowly adding to the quantity. Earlier, I started with the 18,000. As the put spiked, I added more. When the spike came, I added more. Okay, clear, everyone? So I would suggest you all try to I share the journal, try to observe all the expiries, see what actually happened on that day. Could you have managed move on that day? Okay, because see, I have actually managed. That's why I'm sharing it with you, because I have traded expiries like fairly, like almost over expiries, and I've seen what kind of moves come. So that's why I'm emphasizing that the risk management is key. If you're trading zero DT, no matter what expiry is, Nifty people believe is the safest. I believe Nifty is the most difficult to manage. In fact, Bank Nifty is the easiest. Bank Nifty and Sensex are the easiest to manage. Okay, because Nifty premiums are not there and the moves are. Okay, clear. Mid cap you can avoid. Mid cap no need to trade because it can be easily manipulated. Mid cap bank caps you can trade light. Okay, Friday, Tuesday I prefer bank trading Bank Nifty rather than within Nifty. Okay, but this method, try to do it. Okay, we'll trade live again so you get more clarity. But the more you observe, the more you try to dig deeper, then only you will actually understand what is happening. Okay, clear everyone? Okay, so thank you for your time. Okay, I hope you understood how to like navigate zero DT. And again, I'm saying because I got messages from few people that it's like I'm trading this full time, like not able to make money. And see, I'll be honest, trading is a brutal game, right? Very handful of people will eventually make money, and it is the truth. Like, because I have seen, I interact with like any trader you name, like I've interacted almost like trader trading very big size, right? Trader even trading 200 crores I've seen, and they also like when they get too confident go through a very difficult phase. Okay, so only thing I want to emphasize is key is risk management. Because sometimes I also get carried away. Okay, when I'm making money, I take additional risk and all, right? If I make back to back 10 expiries, I'll make money. 11th, I know I'll lose. Because I like, okay, let me just shift the port. Why should I should shift the hedge? There's no need, I can manage, right? And market will give you a loss and you'll realize, okay, now let me again go back to the drawing board again. Let me start the same process. Okay. So make sure you don't lose big. Okay. If you lose big enough, this game is very brutal. And like, see, I am telling you now, I enjoyed trading from 2016 to 20. Okay. But now, because after 20, like 21, 22 was still good. But I think after 20, in 2024, it's actually not lucrative to be a trader. Okay. Because the risk is too high, the reward is not much. So that's why you see I am following much on trend following systems. Okay. So you have to adapt continuously. It's not that what we were doing on day one, we'll keep doing the same thing entire life. As markets evolve, we have to evolve. So now my major focus is on, like I'm focusing a lot on cash market also buying because I see very good opportunities there with like lesser risk. The risk I'm taking in options, the risk there is lesser. Okay, you are well diversified and the leverage is always in control because you can buy up to a limited quantity in cash. Okay, I'm also doing trend following. So we discussed multiple systems, trend following, which is kind of it will work in like basically when the trend is there, it will always work. So focus more on trend following, focus on non-directional for basically cash flow, and focus on also on cash stocks basically for investing or say swing trade. Okay. Options treat it as a cash flow that okay, every month I get 2% cash flow. Okay. Okay. Gaurav, I already explained the method. Same method you can apply for cash stocks also. But if you want, like next time, you'll also again revise that thing also.